Good morning once again. We're going to look at companies income tax. What is company income tax trying to talk about? Yeah, so according to the tax law, company income tax is trying to subject all the income of the taxpayer. Now, when I say taxpayer in this regard, I am referring to corporate bodies. So all the income this corporate body has made, whether within Nigeria or outside Nigeria that relates to Nigeria income, will be subject to tax in Nigeria. Now, and the current company income tax talks about various type of companies that we're going to be talking about as we move ahead. Now, for the purpose of classifying company, according to Finance Act 2019, we now have three types of companies, which will include the small business. This small business is a business that has a turnover of 0 to less than 25 million. Anything above 25 million to less than 100 million, we say the company is a medium-sized company, and above 100 million and above, we say the company is a large-sized company. Now, by implication, that means all these companies are not, excuse me, okay. Is it still covering the notes? Someone said my profile is covering the notes. Okay, let me reset the share screen. Okay, I think this should be fine. So, as I was saying, the company, for example, as their income will be subject to tax based on their turnover that they made. So if a company is in the range of 0 to less than 25 million, such a company shall not pay tax according to the tax law. Where the company has a turnover of 25 million, above 25 million, but less than 100 million, such a company is regarded to a medium-sized company. So such a company will be expected to pay a reduced tax rate. Now, where the turnover of a company is above 100 million, 100 million and above, such a company is classified as a large size company, and such a company will be paying a tax rate of 30%. Note, however, that in the exam, where the examiner did not give you turnover, you are going to assume that the company is a large size company because profit is not the determinant of what's it called, of your tax liability. What determines your tax liability is your turnover. Is your turnover. What determines your tax liability is your turnover. Now, for the purpose of company income tax, companies are expected to file their returns. Now, in the process of filing their returns, there are some requirements that goes alongside with the return being filed by the company. One of the document that goes along filing is your annual returns or your financial statement. Annual audited financial statements are compulsory. You must send it to the tax authority for them to be able to assess your tax, even though the law permits that the taxpayer do a self-assessment, right? But again, even after you have done your self-assessment, the tax authority under their rights also have the leeway or opportunity to also look at that statement you have sent to them and see whether there are some allowable expenses that you have, there are some disallowable expenses that you have treated in your income statement that is now making your tax liability to be reduced. So they look at all those. They also, one of the components of the annual returns is you submitting your capital allowance computation, your asset schedule. The tax authorities also want to see your asset schedule. It's very important. So after you have submitted your audited financial statements, we want to see your tax schedule, your capital allowance computation. We want to see your asset schedule so that we know that this company is not just claiming capital allowance on assets that is not part of their schedule. We want to see your asset schedule. We also want to see your self-assessment return, what you have found. We want to also see that. We also want to see the evidence of payments that you have paid. I hope you guys are jotting, although I'm still going to send you this note. Evidence of payments. How much have you paid based on your self-assessment? The tax authorities want to see it. And at the same time, the tax authorities want to see how you have computed your adjusted profit. Therefore, you are going to tell them all your sources of income, all your sources of revenue. You would inform the tax authority by there, or you state it there. So we are talking about audited financial statements. We are talking about self-assessment form. We are talking about evidence of tax liability paid. That's number 3. We are talking about asset schedule. We are talking about capital allowance computed and your computation of your accessible total profits. Okay, so tax authorities want to see all those. Now, as I was saying, just like I've said, the tax authority wants to see all sources of income of the taxpayer, wherever they are making the income from, whether it is brought in, it is derived, or received in Nigeria. All those has to be part of your income in Nigeria if you are a Nigerian company. Now, there is difference between a Nigerian company and a non-Nigerian company. A Nigerian company is a company that is registered in Nigeria, that is registered and incorporated in Nigeria. That is the Nigerian company for you. A non-Nigerian company is a company that is not registered or incorporated in Nigeria. But again, this non-Nigerian company is carrying on businesses in Nigeria. When we get to that, we are going to be discussing it. Now, for your level, for example, taxation is not all about calculation. There are a lot of notes that you also need to take cognizance of, because the examiner would ask a question on computational aspects, and they also want to see your dexterity in your written or practical aspects. Okay, so all those are very important. So we move on to the next one, registration of company. So Federal Inland Revenue Service and State, I have a standard questionnaire which I expect to be completed by taxpayer. Now, when you are registering your company, these are the things that would be stated in your registration. You want to tell us the particulars of the company, such as name, registered number of company, and the date of incorporation. You want to tell the tax authority. You also want to tell the tax authority the registered office and address of the company. Again, the nature of the business that you guys are engaging, you want to tell the tax authority. Your article and memorandum of association, the certified true copy of that will be sent to the tax authority. Names and address of the directors of the company is needed. Names of the bankers are needed. Names and address of the auditors are needed. Names of the company secretary are needed. Letter introducing the tax consultant of the company is also part of it. Particular of shareholders, stating number of shares, names are also important. All directors, directorship held, each director stating the registered address of each of the companies disclosed. Certified true copy of certificate of incorporation, date of commencement, names and address of the principal officers, and any other information that may be required. We move on to the next one, which is, what is a Nigerian company? Just like I've told you, a Nigerian company is a company that is registered and incorporated in Nigeria. Now, for the purpose of this, Any income derived from brought into Nigeria or received in Nigeria will be subjected to tax in Nigeria. Such profits shall be deemed to be accrued in Nigeria wherever they have arisen, worldwide, anywhere you have received the income. It does not matter. It will be assumed that it has been earned in Nigeria. Take, for example, GTB has a branch in London or Sierra Leone. When GTB is registering, when GTB is reporting their group accounts or reporting their accounts, rather, they will not be reporting, what was it called? The branch office in Sierra Leone as a subsidiary. Okay, they will be reporting it as a branch office. Except if, because of tax management now, a lot of idea will be coming into the tax group in each of the companies. So, and if they open GTB in what's it called in Sierra Leone as a subsidiary, that is not part of Nigerian company. Do you understand me? We're going to be talking about Nigerian company and foreign subsidiary when we move on. Now, in that case, if the foreign company, that is a company that is a subsidiary, GTB Sierra Leone is a subsidiary of the Nigerian company, it is not going to be subject to tax. GTB Sierra Leone will not be subject to tax because it's a subsidiary, a foreign subsidiary. The only thing that is going to be subject to tax is a dividend that we as a GTB company in Nigeria will be getting from the GTB subsidiary in Sierra Leone. Do you understand me? So that is that. So we're going to still talk about some relationship between Nigerian company and a foreign company, foreign subsidiary rather, Nigerian company and a branch company. Okay, so branch of the Nigerian company. Take for example, GTB again has head office in Ademola Adetokunbo. Okay, now Adeyemo Alakija rather as their head office in Adeyemo Alakija. Take for example that in each of the states you guys are currently, you have GTB offices there. So when the tax authority is looking at GTB, they are not looking at a branch as a subsidiary. Rather, they are looking at a branch as part of GTB. And when they are going to submit the tax, the company tax, they will be looking at the branch as part of the head office. They are not going to be looking at them separately. But if, for example, GTB has another subsidiary, take for example again, Asa Mansard. Mansard used to be a GTB insurance company in those days, right? Now, but I'm still sure up to now, GTB will still have shares in Asa Mansard. Why GTB had to leave Asa Mansard then? You remember that it's GTB Assurance then. So why they had to divest that was because of the policy change of the CBN, that when you are into bank, face your banking operation. And that was why GTB had to divest that GTB Assurance to another company. Okay, but I'm still sure that GTB has shares in Asa Mansard. Now, what we're trying to say there is that as a subsidiary to GTB, that subsidiary is not going to be taxed alongside with the GTB. GTB is a distinct company from its subsidiary. In terms of tax, there is nothing like group tax. It is going to be individual taxes rather. So we are going to subject GTB to tax separately, and we'll also subject the subsidiary of GTB Bank to tax separately. Excuse me. So in terms of returns that GTB will also get from that company, it is dividend from that company. Okay, you are not getting any other thing. So when the company is going to generate the tax, they will subject that company to tax differently from GTB. So that is that about Nigerian company. I have any question? You can ask me. before we move to non-Nigerian company. Okay, the next one is a non-resident company engaged in any form of trade or business in Nigeria. The profit shall be deemed to be derived from Nigeria for tax purpose if the following occurs. Now, just like I've told you, a non-resident company is a company that is not registered or incorporated in Nigeria. The company is not registered or incorporated in Nigeria. Now, when you say a company is not registered in Nigeria, but make some profits from Nigeria, how would you subject the company to tax in Nigeria? That's what we are going to be looking at. Examiner will ask you, for example, that how would a foreign company?
Hello, sir.
Yeah.
Can I ask a question, sir?
Fine.
Okay, sir. Before you continue again, I want to ask, in a situation where you had a company and then there are other brands under the company, they are not subsidiary because they are not separately incorporated. So, but you have different products you are selling. Take, for example, you had a company, Alpha Beta, and then you are producing cement, you are doing probably fashion and designing, you're doing a restaurant. All of this under Alpha Beta, how do you account for this? Or how do you subject these different brands into tax?
You've just said it's their branches, okay? Branches are subject to tax alongside with the head office. So they are not seen differently. They are still the same. Do you understand? So irrespective of the fact that they are doing, okay, you know, for example, I'll still use banks, for example. In some banks, they will tell you that this place is for corporate companies, it's for companies. Okay, corporate account goes there. It's not as if when or what's it called, when individual wants to access them, they will not be able to access them. But majority of what they do, majority of the products they focused on is companies, corporate accounts. Another branch, majority of what they will focus on, especially look at, for example, banks that are around what's it called, markets. Okay, their major target, the products they will be selling there will be different from banks that are in an industrial estate or that are in, take for example, if you are in Lagos, you would understand that in Lagos Island, for example, is where you have most of the corporate head offices in Nigeria. Okay, and you know that Computer Village is where you have most of the guys that sell phone. Okay, so a bank can be located there and be only attending to people that their turnover is no more than maybe 10 million or 20 million. So they will say, we want to capture small organization. So the product they will be selling there is small organization products. Another one will be looking at VI. The product they are selling there is for corporate. So irrespective of the product they are selling, whether they are selling for products, the product of for small company or large company or whatsoever, the kind of product they want to sell, irrespective of the fact that they are selling that and they are still a branch of the head office, is the same corporate goal. And because it's the same corporate goal, we are going to be subjecting them to tax as if they are still part of the head office, irrespective of wherever they are located. Dangote, for example, as Dangote Sugar, Dangote Cement, Dangote Chemical, Dangote, do you understand? So those companies form one Dangote, okay? So irrespective of the branch, so they will still be subject to tax as one. Okay, let's go ahead. The next one is a non-resident company. How do you subject the income of a non-resident company to tax? I haven't known that this company does not reside in Nigeria. They don't have office space in Nigeria. They are not residents in Nigeria, but they only carry out business activity in Nigeria. How would you subject them to tax? Now, there are 4 ways that this, in fact, 5 now, that these companies could be subject to tax. 5 ways now. Now, the first one is if a company has a fixed base operation in Nigeria, such a company will be subject to tax on the profit that is attributable to the fixed base operation in Nigeria. What do I mean by fixed base operation? They have a location that you can trace them to, but they are not Nigerian company. Microsoft office is in VI. Okay, Alfred Wani. Okay, that's where they are in Lagos. Microsoft is not a Nigerian company, but they have a fixed base operation in Nigeria, and they sell products to people in Nigeria. They make profits in Nigeria. So that portion of profit that Microsoft is making in Nigeria shall be subject to tax in Nigeria. Shall be what? Subject to tax in Nigeria. So the first thing you will say is where a company operates a fixed base operation in Nigeria, such a company shall be subject to tax on the profit attributable to the fixed base operation in Nigeria. That's number 1. Okay, that's number 1. Profit attributable to the fixed base operation will be subject to tax in Nigeria. The next one. Now, a company does not have a fixed base operation in Nigeria, but habitually operates in Nigeria. That is, there is no location, there is no office, but through an authorized agent, this company is carrying out business activities in Nigeria. Okay? Now, such a company will also be subject to tax on the profit that is attributable to that business that is being habitually operated in Nigeria. For example, Aramide is a phone distributor, right? Now, imagine that Aramide now has a company in China or US that wants to enter Nigeria market, but they are still skeptical. They now say, okay, Aramide, we are going to be sending you our phone to be helping us market it in Nigeria. Just market our phones for us, our product for us. Okay. Now, Aramide is now managing the product for them, even though they are not in Nigeria, but Aramide is marketing the product in Nigeria and selling it. So Aramide will be treated as the agent that is authorized to sell the product of this foreign company in Nigeria. Any profit attributable to that operation shall be subjected to tax in Nigeria. Now, I know the question you want to ask me. You will now say, Mr. Christopher, how would they know that this company is habitually operating in Nigeria? And that is why you have to, you as a tax person or tax payer, will be the one to disclose rather to the tax authority your sources of income, because the tax authority would not know. The tax authority would not know. So you'll be the one that would inform the tax authority your sources of income. The next one. Now, another one is that this company does not maintain fixed operation in Nigeria, does not habitually operate in Nigeria, but maintain a stock of goods in Nigeria. You have where you regularly come and make deliveries of goods. You are not in Nigeria, but you have a warehouse where you display your goods. You are not in Nigeria. You display your goods on a regular basis. Imagine there is going to be trade fair. Okay? You know, a lot of companies that come for trade fair in Nigeria, they are not Nigerian companies. Okay? Now, we are saying that display of goods that you have done in Nigeria that resulted into you making profit in Nigeria will be subject to tax in Nigeria. That's what we are saying. Habitually operate in Nigeria, maintain a stock of goods or merchandise in Nigeria, which deliveries are regularly made by person on behalf of the company to the extent that profit is attributable to business in Nigeria through that person. So we are saying that you maintain a stock of goods somewhere, okay, and on a regular basis, you are making delivery, you are delivering the goods, and people are buying it, they are patronizing you. We are saying that profit attributable to this shall be subject to what? To tax in Nigeria. The next one. The next one is where a company that is not a Nigerian company operate a turnkey project. Operate a turnkey project. What do we mean by turnkey projects? Turnkey projects will occur where a company carry out a singular delivery, contract of survey or delivery or installation. Any profit that is attributable from that contract of survey, delivery, construction, installation will be subject to tax. Take for example again, a foreign company comes to Nigeria for the purpose of constructing road for you. They don't have intention in staying in Nigeria. Again, Julius Berger. Again, CCE, those companies doing a train for Lagos State. The company doing train for Lagos State. They are Chinese company. They are not in Nigeria. They are not registered in Nigeria. So all they have come here to do is to construct road for you and go. So it's a singular contract of survey, deliveries, or installation or construction. So they are not here to be doing business on a regular basis. They are just here to construct the road and go. So any profit attributable to this kind of company shall be subject to tax. We have mentioned 4. Number 5 is digital transaction and services rendered by a non-resident company. So we are saying the number 5 is where a company derives income from digital transaction. Where a company derives income from digital transaction, such a company shall be subject to tax in Nigeria. Where a company derives income from digital transaction, such a company shall be taxed, subject to tax in Nigeria. Facebook is not a Nigerian company, but if you look at it today, Facebook in Nigeria is making a whole lot of money in Nigeria, isn't it? Twitter is not a Nigerian company, but when you look at it today, Twitter is making a whole lot of money in Nigeria. AliExpress is not a Nigerian company, but look at it today, it is making a lot of company profit from Nigeria, and so on and so forth. A lot of companies that are not Nigerian companies, but unfortunately, because we do not have law to capture this digital economy before, they tend to escape payment of tax liability. So, and in 2019, Finance Act was introduced for the purpose of subjecting this income to tax. Finance Act 2019 was established to subject this type of companies to tax. Now, what is this trying to say? Because the examiner can ask you about significant economic presence. Now, what is significant economic presence? This context. We are saying a non-resident company would have a significant economic presence in Nigeria if you follow your call. Number 1, such a company derives an income that is 25 million and above in Nigeria through that digital means, 25 million or equivalents in other currency. So take for example, Nigeria now, our exchange rate is about 1,006, right? Now, the company is not a Nigerian company, but the company, for example, sell or sold a digital transaction to a Nigerian individual, okay, and makes a turnover of 25 million or its equivalent in other currency. such a company shall be what? Subjected to tax in Nigeria, because it will be deemed as if the company is present in Nigeria. So, and that's what we call significant economic presence in Nigeria. Okay, it is assumed that the company is in Nigeria indirectly. So, if a company derives a revenue of 25 million and above in Nigerian currency or its equivalent, then such a company shall be said to have significantly present in Nigeria. Number two, where a company uses Nigerian domain name to register its websites, when you use Nigerian domain name to register your website, that means you are operating in Nigeria. Do you understand? You use Nigerian name to register, you use Nigerian domain name to register your website. What that means is that the company is also operating in Nigeria, significantly present in Nigeria. Number next. When the company has an interaction with Nigerian company and by stating its product price in Naira to target Nigerian customer. So because you want to target Nigerian customer, you began to state your prices in Naira. Then you are significantly present in Nigeria. You are significantly what? Present in Nigeria. The next one. So those are the reasons why we can say that a company is significantly present in Nigeria if the following that I've said occurred. Let's go again. Let's go through it again. Number one, we said if the company is making a revenue of 25 million and above in Nigeria, we say the company is significantly present in Nigeria. 25 million and above in Nigerian currency or equivalent currency like USD, then you are what? Significantly present in Nigeria. That's number one. Number two, we say if you register your domain name using Nigerian websites, using Nigerian domain name, or you register a website in Nigeria, that means you are trying to capture Nigerian markets. Therefore, such a company is deemed to be significantly present in Nigeria. Number three, we said as a purposeful or sustained interaction with person in Nigeria by customizing its digital products to target Nigerians, to target persons in Nigeria. So by stating your prices of products in Naira or services in Naira, then we can reasonably say that you are constitute significant economic presence in Nigeria. So having said that, we move to the next one. What are the types of services that we recognize as that the authority will recognize as revenue that constitutes significant presence? Now, we say number one is streaming and downloading digital content. Streaming and downloading digital content. So the company will be said that the company is now what? A Nigerian company, is in Nigeria, is making profit in Nigeria. For example, YouTube. YouTube is not in Nigeria, for example. But a lot of people, what they do is they stream and download content. And the company that owns this content that you are downloading or streaming, they are not Nigerian companies. So we are saying that these companies will be subject to Nigerian tax because people in Nigeria are downloading and streaming your content. So any income the company makes from that will be subject to tax in Nigeria. The next one is transmitting of data collected about Nigerian users. That is what we call affiliate marketing. You transmit data of Nigeria to users, okay? So with that, they'll be able to have information of Nigerians, right? And use it for digital means and begin to advertise to them, right? So any income you make from transmitting this data will be subject to tax in Nigeria. The next one is provision of goods or services directly or through a digital platform. All of you that usually sell your products through digital means, you are supposed to be what? Paying tax in Nigeria. Even though you are not in Nigeria, anywhere in the world, wherever you are in the world, the fact that you are transmitting and selling digital products, whether it is physical or not, you are selling it to Nigerians, such will be subject to tax in Nigeria, provided you have gotten to a threshold of 25 million. Provided you've gotten to a threshold of 25 million and above. The next one, any services that link supplier to customer. Any services that link supplier to customer and you make gain or you charge from that, such will be subject to tax in Nigeria. Take for example, you as a person, you have a contact of a supplier in China. Someone comes to you and say, bro, I want to buy stuff in China, but I don't have a reliable supplier. Do you have a reliable supplier for me? You now say, why not? Yes, now I have a reliable supplier. Okay, the person now said, please give me the details of the supplier. You went ahead and gave the details of the supplier. But in the process of giving the details of the supplier, you charge. Okay, so any income derived from such shall be subject to tax in Nigeria. Shall be what? Subject to tax in Nigeria. So that is what we are saying. So that is that. Any question before we move ahead? Any question? Okay, in the absence of none, we'll go ahead. The next one is where a non-resident company provides professional, consultancy, management, and technical services. This will not constitute, we are not looking for 25 million in this regard. And for this kind of a service that the taxpayer renders, the taxpayer shall be subject to tax at the rate of 10%. And the tax we are subjecting them to here is withholding tax. Okay? So where a company, a non-resident company, provides professional, consultancy, and management services or technical services to Nigerian residents, the profit will be subjected to tax, the revenue will be subjected to tax at the rate of 10%. And this 10% shall be the final tax liability. Okay? So that is that. The next one. With effect from 2021 Finance Act.
Sir.
Yes.
So please, can you explain this 10% again? I didn't really understand it.
Thank you. So what we are saying here is that if a company that is not a resident company, that is non-resident company, renders a service to a Nigerian company, and these services include professional service, consultancy service, management service, and technical services. Okay. Any income derived from these services that this non-resident company renders to a Nigerian company shall be subject to withholding tax of 10%. And this withholding tax shall be the final tax liability on the income. Shall be what? The final tax liability on the income. Do you understand?
Yes,
So
sir.
if the
Thank you, sir.
examiner asks you a question to say something about significant economic presence in Nigeria, the number one thing that you talk about is where the revenue is 25 million and above in Nigerian currency and other currency. That means the company has constituted a significant presence in Nigeria. That's number one. Number two, we said if the company has registered its domain name in Nigeria or uses a Nigerian domain name or register its websites in Nigeria, such a company will be deemed to have been significantly present in Nigeria. That's number two. Number three, anything that a non-resident company does to target Nigerian markets, for example, stating your product price in Naira, that means you are targeting Nigerian market. That means such a company is significantly present in Nigeria, even though they are not here. That's the first three things we will talk about. The next few things that you talk about is you now talk about what are the things that can constitute revenue for a company to be said that, for us to say that the company is now significantly present in Nigeria. What are the kind of revenue they can make? We say number one, streaming and downloading of digital content. That's number one. Number two, we said that company, any form of service that you do in form of linking supplier to customer, okay, will also be treated as though you are significantly present in Nigeria. That's number two. Number three, we said when you sell digital products, whether by service, when you render a digital service or digital products to a Nigerian resident, that means such any income that you derive from that will be subject to tax in Nigeria. Those are the things that you will say. You will now also go, you will also say that where a company, a non-resident company, renders a service of professional management, consultancy, and technical service to a Nigerian company, the revenue derived from this kind of services shall be subject to tax, to withholding tax at the rate of 10%. Shall be subject to what? A withholding tax at the rate of 10%. And that will constitute the final tax liability on the transaction. So that means we've been able to talk about significant economic presence. Now, again, for the purpose of anti-tax avoidance, we are also going to be talking about turnover assessment. Turnover assessment of a non-resident company. Turnover assessment of a non-resident company. Now, Finance Act 2021 as amended Section 30 of company income tax. So we said a non-resident company shall be assessed to tax so to assess a non-resident company with a digital economic presence in Nigeria to tax on fair and reasonable proportion of their turnover. Now, how does turnover assessment occur? You remember, I don't know, maybe you have done this before. Section 30 of Companies Income Tax Act talks about turnover assessment. Now, for turnover assessment, we are saying that turnover will become, a company will be assessed on turnover based on the following reasons. Number one, where there is no accessible profit. that is, the company will be able to tax on what? On turnover. When you have said you do not make accessible profit, or there is accessible profit, but the accessible profit is less than expected. Therefore, the company will be assessed to tax on its turnover on a fair and reasonable proportion. So we are now saying, for example, a non-resident company that is significantly present in Nigeria is now telling us that I do not make profits. There is no profit. Even though we know that this company is most likely to have made profit based on some information that we have. The tax authority has rights to subject the taxpayer to tax on its turnover. Okay? So that is that. Do you have any question from me? Again, for a non-resident company that's with significant economic presence in Nigeria, they are also supposed to file their returns. Okay? Let's go. Relationship between a Nigerian company, Nigerian branch, and parent company. We have discussed this at the beginning of this class. Relationship between a Nigerian company and Nigerian branch. A Nigerian branch of a resident company, whether located within Nigeria, will be whatever located within Nigeria, will be treated as one single entity, liable to tax under federal tax jurisdiction. A Nigerian branch of a foreign company is treated as corporate entity, and any income or profit derived by it from Nigeria is subject to what? To tax. A Nigerian branch of a foreign company. Look at this now. A Nigerian branch of a foreign company. I am not saying a subsidiary of a foreign company. A Nigerian branch of a foreign company shall be subject to what? To tax in Nigeria. Okay? Now, what are the conditions to subject this company to tax in Nigeria? The only two conditions where branch will not be subject to tax in Nigeria is, number one, if the branch is solely for storage or display of goods, it is not going to be subject to tax in Nigeria. Okay? But don't forget that we said this company will also be subject to tax as a non-resident company in Nigeria. Okay? But for the purpose of this, we are saying we will not combine it to Nigerian company. The next one is where it is used for solely for collection of information. You just want to collect information. So it's not a Nigerian company. Though we are still going to look into them, we are still going to ask them to file their returns and see whether they have any profits that is attributed to them in Nigeria. If there is any profit attributed to these guys in Nigeria, they'll be subject to tax in Nigeria. The next one. Relationship between a Nigerian subsidiary and a parent company. A Nigerian subsidiary and a parent company, they are two separate entities. They are two what? Separate entities. They are not the same. So you are not subjecting them to tax the same, like what you did for Nigerian company and the branch. They have two different management. Therefore, when you are subjecting them to tax, you subject them to tax separately. Okay. However, what a Nigerian company will get from the subsidiary, just like I've explained to you the other time, is dividend, which should be treated as frank investment income. Frank investment income is the income that is already subject to tax in the hand of the recipient and will not be subject to tax further. Okay? And cannot be what? Subject to tax any further because it has been subject to tax once in the hand of the taxpayer. An example of frank investment income is dividend. Okay, that is that. Overseas branch of a Nigerian company. Overseas branch of a Nigerian company is an extension of a Nigerian company operating outside Nigeria and as a Nigerian company permanently established in another country. So overseas branch, for tax purposes, the profit of overseas branch of a Nigerian company is deemed to be derived in Nigeria and shall be fully liable to tax in Nigeria, because the income of a resident company in any year of assessment shall be on its worldwide income, except that the Nigerian company shall be granted double taxation relief on a foreign tax offer. And that is why, you know, the branch of a Nigerian company would have also subjected to tax in another country, okay, based on their tax laws in that country. So the tax authority will allow the taxpayer to calculate relief based on double taxation agreement. Mr. Idris must have taught you double taxation. So that's what we are talking about here. Okay, so that is that. The next one, overseas subsidiary. Overseas subsidiary is an investment arm of a Nigerian company. So they are not supposed to be subject to tax in Nigeria. They are overseas subsidiary. Okay, but the income that is being derived from this overseas subsidiary will be subject to tax only on withholding tax. Withholding tax will be subject, they are going to be subject to tax on their income at 10%. That is, withholding tax will be calculated on the income derived by these companies. It's only withholding tax. So that is that. So let's go again to filing of returns by a resident company. We have talked about this before. We've said the audited financial statements, tax and capital allowance computation for the year must be submitted, and true and correct statements in writing containing the amounts from each source must be stated. Now, the next one, a duly completed self-assessment form from time to time must be submitted, and evidence of tax liability must be submitted. Evidence of payment of tax, whether you have paid it in full or you have paid in parts, must be submitted to the tax authority. The next one, filing by non-resident company. Audited financial statements, that is the full audited financial statement of the company, must be submitted, the full one, and the audited financial statement of Nigerian operation, attested to by an independent qualified accountant or certified accountant. This statement was included because of ANAN member. Before now, ANAN member, no, they don't give certificates, they don't certify accounts. But with effect from this, ANAN member too can now be certifying account. It is only chartered accountants in Nigeria that can certify accounts. It is only the chartered accountant in Nigeria that can certify accounts. Okay. The next one, tax computation schedule based on the attributable tax computation schedule based on profit attributable to Nigerian operation and self-assessment return. Any completed company, self-assessment return, we have talked about that. And a true and correct statement in writing containing the amount of profit from each and every source in Nigeria. That is that. Notes that where a non-resident company only earns withholding tax on where earned income for which withholding tax is final. That is on professional, consultancy, management, and technical service. The obligation to file returns shall not be applicable. We are trying to say that in this regard, it is possible that the income that is being derived by this company, that is this non-resident company, is from professional, consultancy, management, and technical services. So we are saying that this kind of service is not taxable. Sorry, we are not supposed to file returns. The next one. Time limit for filing returns by company. Basically, we are going to be talking about two types of company here. and I want you to take notes. Number one company is a company that is just commencing operation. Number two company is a company that has been in business for so many years. Number one company is a company that is just commencing operation. Number two company is a company that has been in business for so many years. Now, for a company that is just commencing operation, such a company is expected to file returns within 18 months after the date of incorporation or within 6 months after the accounting year end, whichever is earlier. I'll say it again. For a company that is just commencing operation, such a company must file returns within 18 months from the date of incorporation and within 6 months after the date of commencement, which after the end of the first accounting year end, rather. After the end of the first accounting year end, 6 months after the end of his first accounting year, whichever is earlier is what the tax payer would do. So you must file your returns within 18 months from the date of incorporation or within 6 months after the accounting year end, whichever comes first. First. What about company that has been existing for so many years? Such a company must file its returns within 6 months after the accounting year end. For a company that has been existing for so long, that is, the company is not just starting operation. Such a company must file its returns within 6 months after the accounting year end. So imagine a company accounting year end is 31st December. So such a company must file its returns within 6 months after its accounting year end. Now, what are the penalties for late filing of returns? Penalty for late filing of returns. A company that is supposed to file its returns, as said earlier, and failed to file its returns will be liable to a penalty of 25,000 in the first year of return, in the first month of failure, and every subsequent month. And every subsequent month, it will be paying 5,000. And every subsequent month, it will be paying 5,000. So if, for example, your date of filing, you are supposed to file within 6 months. That is, take for example, a company that you're supposed to file its returns 6 months after the accounting year end. That is, take a company that has its own accounting year end to be 31st December. That is 6 months after that will be 30th June, right? Now, if the company failed to file its returns within after that 30th June, that is 1 day after, the company will be paying 25,000 in that first month. That is July, all through July. That you did not file your return, you will pay 25,000 in the first month. And by August, you will pay 5,000. By September, you will pay 5,000. By November, do you understand? You continue to pay 5,000 for every subsequent month. Now, the next one is if we notice that it is any of the director or principal agents, principal agent of the company, like CFO, like director that is supposed to do his work and he refused to do it, he refused to review the statements and, unfortunately made them not to file their returns on time, or any principal agent of the company. If this is identified, the company shall be assessed, the individual will be liable to a penalty of 100,000 or a prison term of 2 years or both. So if we have been able to identify that it is through the neglect on the part of any director, manager, secretary, or any other person that is designated to file return and fail to do such, okay, the person will be liable to an imprisonment term of 2 years or a fine of 100,000, okay, or both, depending on the mood of the tax inspector or the tribunal at that time. So that is that. Yeah. Is that clear? Any question before we move to the other thing that we need to talk about? Any question? Any question? Okay, in the absence of none, we will move on to the next thing. Extension of period of filing of returns. A company can make application before the expiration of the stipulated time. So, for example, you will not be able to meet up with the deadline. Before it expires, before the expiration time, you must have written to the tax authority that you will not be able to meet up with filing of returns, and you must give them cogent reason. And the only reason that the law talks about is one, maybe there is a debt of principal officer, such as the CFO of the company that is supposed to sign the financials, or director that is in charge, or chairman dies, or there is a natural disaster or pandemic. Now, you remember during the COVID period, a lot of extension was even granted by the tax authority themselves, because they know that many companies will not be able to file returns as a when due. So they granted them exemption. Okay. So we are saying there are two ways in which the taxpayer will be granted exemption from not filing returns. Number one, from not filing it at the point of at the date it's supposed to be filed. So number one, the taxpayer must have written to the tax authority before the expiration of the what's of the what's it called, filing period. That's number one. Number two, the company must show a reasonable cause of its inability to file returns or to comply with the act. And the example of this is deaths and natural disaster. Even though the tax authority has given you all these what's it called, all this concession, that will still not mean that you will not file your returns. And that will still not mean you will not pay your tax liability. Okay, so that's that. Okay, let's go. Let's look at this illustration. Wealth Limited is a stockbroking firm registered to operate in capital markets in Nigeria. It commenced business on 1st of July 2019. The company audited accounts have reviewed the following. The period ended 31st December 2020, 18 months, 84 million. Year ended 31st December 2021. Year ended 31st December 2022. The company did not file any tax return to Federal Inland Revenue with respect of its accounts for the year ended 31st December 2022 until March 2022. You are required to state the documents. You are required to state the document required to be filed for tax return with relevant tax authority. Number two, state the information that should be included in the company income tax return by a stockbroking firm and calculate the penalty for late filing of returns by this company. So I'll send all those notes to you. Now, the company defaults to file its returns, look at it, until for this period, until what? March 2022. That means this guy is supposed to file within 6 months after this period. That is June 30, 2021. So if he did not file within this period, that means he will be liable to a penalty of 25,000 in the first month of default. The first month of default year is what? Is July. Abi 21, 25,000. He also refused to file for August, September, October, November, December. That is 5 months. 25,000. He did not file for January, February. That is 2 months. 10,000. He now filed for when? He now filed March. So he will be liable to a penalty of 25,000 in the first month, 5,000 for every subsequent month that he failed to file. So, and that is the penalty the guy will pay. Do you understand? Ask your question before we move on. Any question?
Yes, sir.
Go ahead.
Please, the late return penalty calculations, can you explain again? Thank you.
Okay, let me re-explain. I said when a company fails to file returns, excuse me. That's 1,000. So we are saying that, for example, this company failed to file returns as and when they're supposed to file. You remember the principle. We said you must file return within 6 months after the accounting year end. Now, the accounting year of this company was supposed to be 30th June 2021 because they said it did not file return until March 2022 for an accounting year end of 31st December 2020. So, and it's supposed to file return, the first return is supposed to be due max 30th June 2021. And because he has failed to file return for that 30th June 2021, in July of that year, the taxpayer will be faced with a liability of 25,000 in the first month of failure, which is 25,000. So for every subsequent month of failure, you know, the guy filed return March 2022. So that is August, September, October, November, January, February, it did not file returns, right? So in 2021, it did not file returns for 6 months, July, August, September, October, November, and December, 6 months. In 2022, he did not file that same return for 2 months, January and February, and he now filed March. So we have to calculate the penalty on a monthly basis for him that he's going to pay, that the company will pay. Book of accounts. Now, every company in Nigeria now has now been expected to maintain a book of accounts of all their transactions containing all information of the company. So that when tax authority asks you, you'll be able to what? Give them the books of accounts. Are you getting me? So you are supposed to maintain a book of accounts that shows all the record of the accounts containing sufficient information and data of all transactions. Now, number 2 is that this book of accounts must be maintained in English language for the purpose of taxation. For example, there are some companies that will maintain their book of accounts in other languages that is not Nigerian language. Okay? Maintain it in Nigerian language. They will maintain it in another language. Okay? So what we are saying here is that this company, they must translate the non-Nigerian language into Nigerian language, into English, for example, English, because the tax authority in Nigeria uses English in whatever they are doing. So you must use English. So, and in the process of translating this, you must use a sworn affidavit. And this sworn affidavit must be done by, it must be done by a sworn translator. So the person that will translate it must provide a certified true copy, that I'm the one that has transcribed this into English. Now, the payment of that will be borne by the taxpayer, not the tax authority. So you cannot come and give me a financial statement that you have in what's it called, in Chinese language, for example. I will not understand it. Give me the one that you have done in English language. And when you are translating it, you must do that at your own cost, not at the Federal Inland Revenue cost. Now, any taxpayer that fails to maintain books of accounts, any taxpayer that maintains book of accounts must, number one, that fail to maintain will be liable to a penalty of 100,000 in the first month of failure and 50,000 for every subsequent month in which the failure continues. 100,000 in the first month of failure and 50,000 for every subsequent month in which the failure continues. Now, any record or book of accounts is requested is supposed to be kept in the company for at least 6 years after the accounting year end. So we are saying 6 years after the accounting year, you must keep your books. Your books must be kept intact for tax authorities, because the tax authorities can come at any point in time to come and check your book of accounts. You must keep it at every point in time. Okay? And that is that. Now, the next one is payment of tax liability. Payment of tax liability. Payment of tax liability. Now, basically, taxes will be paid in, could be paid in 4 ways. The tax authority could assess an income of the taxpayer to tax in different ways. 4 ways, for example. The first way is that the tax authority could assess the taxpayer to tax on dividend. Number 2, the tax authority could assess the taxpayer to tax on total profit. Number 3, the tax authority could assess the taxpayer to tax on its turnover. And the last one is minimum tax. Minimum tax. So let's take them one after the other. So let's go one after the other. Minimum tax, tax liability based on dividend. Tax liability based on dividend. Tax liability based on dividend. Now, the taxpayer shall be subject to tax based on its dividend if the following occur. Section 19 of SITA states that when the following occur, the taxpayer shall be assessed to tax on it. Number 1, we say where there is no total profit. Where there is no total profit. Where there is no total profit. Excuse me. Where there is no total profit, the taxpayer will be assessed to tax on its dividend. Where there is no total profit, the taxpayer shall be assessed to tax on its dividend. So we are saying you don't have profits, but you went ahead to distribute dividend to your shareholder. We are saying the taxpayer shall be assessed the tax on dividend. That's number one. Number two, there is total profit, but the total profit is less than dividend declared. There is total profit, but the total profit is less than dividend declared. The taxpayer shall be assessed the tax on dividend. Let's go again. Number one, there is no total profit. Number two, there is total profit, but the total profit is less than dividend declared. In that instance, the tax authority says, or the CITA 2004, as amended, says that the taxpayer shall be assessed with tax on dividend. However, in 2019 Finance Act, the Finance Act gave some exemption to this provision. The Finance Act gave some exemption to this provision. Number one exemption to this provision is that dividend shall not be assessed to tax if there was an evidence that dividend was made out of retained earnings. We all know that most of the time, dividend is always from retained earnings. It's most of the times from retained earnings. So we are saying that if the dividend is from retained earnings, the taxpayer will be what? Shall be exempted from being assessed the tax on its dividend. Do you understand me? That's number one. Number two. Number two is if the dividend is from frank investment income. I'll come back to that. I'll come back to my explanation. If the dividend is from frank investment income, such will not be subject to tax. So profit on income of the company that are regarded as frank investment income will not be subject to tax. So what we are trying to say here is that if the dividend of the company is gotten from an investment in another company, such will be exempted from tax. You are going to exempt it from tax. Number three is if the distribution is from real estate investment company. If the dividend is from real estate investment company, such a dividend will be what? Exempted from tax. Such a dividend will be exempted from tax.
Excuse me, sir.
Go ahead.
Sir, please, why is it so? For the dividend of real estate companies, why is it exempted from tax?
So this is one of the what's it called? The acts that the government brought us. They just want to encourage the what's it called? The real estate investment company, so that when they make dividend, they can invest it back into the business. Okay. The next one is profit already exempted from tax will be subject to tax. Will also be exempted from tax. So profits that is already exempted from tax by the provision of pioneer legislation or petroleum profit tax will not also be subject to tax if it is distributed as dividend. So let's go. Let's go and see this dividend paid out of retained earnings. Let's see how it works. And that's where we'll start today's class. So dividend paid out of retained earnings of the company will be exempted from tax. So let's take illustration one. Illustration one. An extract from Financial Statement of Retention Policy Limited for 2021 shows the following. Loss for the year ended, for the year, 1.5. Retained earnings brought forward, 11 million. Dividend distributed, 1.5 million. Will this dividend be subject to tax? Will this dividend be subject to tax? Will this dividend be subject to tax? Who is talking? Will this dividend be subject to tax?
No, sir, it will not.
Why?
Because it is made from the return, and the company made a loss for the year. So the dividend is paid from the return earning of the company.
Solid answer. The dividend was from retained earnings because there are also profits. So it is evidence that the company will not be able to pay the tax, the dividend, Abi. But when you look at what is happening here, you notice that the dividend was from what? Retained earnings. So that answer is correct. From the above illustration, the 1.5 million paid will be exempted from what? Application of section 19, because it is reasonably clear that the dividend was paid out of retained earnings. Next. Look at this illustration and tell me what you think. What do you think?
So I think the dividend is a combination of the dividend from the profits and dividend from retained earning, because the dividend paid is more than the actual profit for the year.
Good. Good, good, good. So what will be your response?
We'll calculate and get the amount from the current year and tax it, while the amount from the retained earning will be exempted from tax.
How much is from retained earnings?
5 million, sir.
5 million.
Sorry, 4 million. 4 million.
I think the retained earnings is the amount brought forward now from previous.
Okay, sorry.
Add up to the profit.
Dividend for this is supposed to be 11.
Is it not?
From retained earning is 4 million, yes, sir.
Okay, so that will be exempted, right?
Yes, sir.
So, and the remaining will
11
be subject
million.
to what? To tax.
To tax, yes, sir.
You are correct. So, look at it. From the above, 4 million from 15 million can be seen to have been what? Paid from retained earnings of the previous year. Hence, the amount to be subject to tax will be what? Subject to 11 million, right? So we subject the 11 million to tax and 4 million will be exempted. Let's go. Look at this one. Tell me, what is happening here?
Okay, so let me attempt.
Right.
With the amount of the year's profit being 52 million and the dividend declared is 42 million, probably the company did not distribute all the profit made as dividends.
Okay.
Or maybe
What's
they
the
declare,
conclusion? What would we do?
who tax the profit.
Who else? Who else? Who else? Is she the only one in the class?
The dividend declared will be taxable. 42,000.
The dividend will be taxable, okay? Who is talking again? Who is talking again? The dividend shall be exempted from tax. The dividend shall be exempted from tax. The only thing that will be taxed here is the profit, because when you look at it, it is sure that the dividend was paid from retained earnings, isn't it? It wasn't paid from the account, so it will be exempted. Sorry, the dividend will not be exempted, rather. The profit will be subject to tax. So when you look at it, this year we are supposed to distribute dividend, Abi. So in this year, for example, we have distributed 42 million and retained 10. Do you understand me? So what we are trying to say here is that the dividend paid will not be exempted because it was not paid from retained earnings. Abi? It was not paid from retained earnings. Retained earnings is 105. Dividend was 42. Profit for the year was 52. That means the profit for the year has capacity to pay the dividend. Profit for the year has the capacity to what? To pay the dividend. Therefore, the dividend will be subject to tax. It will not be exempted from capital from tax. So invariably, by you taxing the entire amount, the 52 million, that means you have taxed the dividend for that year. So we are taxing the entire 52 million. Do you understand?
Excuse me, sir.
Go ahead.
Yes, sir. If we are taxing the 52 million, it means the dividend to be exempted, right? The dividends
It
will
is
not
not
be
exempted. It is not
Sir?
exempted. The dividend is not exempted. We are also taxing it.
So, sir, do you mean we tax the 52 million and we also tax the 42
No.
million?
So the
Okay.
42 million is inside that 52 million.
Okay, all right, sir.
Any other question? Any other question? So let's quickly go ahead and talk about CIT based on turnover. CIT based on turnover. CIT based on turnover. Now, just like I explained to you the other time, for a non-resident company that operates significantly in Nigeria, we are saying that turnover assessment will occur in two situations. Number one, where the Nigerian company has no accessible profits, or there is accessible profit, but the accessible profit is less than expected. Number one, there is no accessible profit. Number two, there is accessible profit, but the accessible profit is less than expected. Therefore, the tax authority would assess the taxpayer to tax on the reasonable proportion of the turnover. So the reasonable proportion is not known. It could be 10%, it could be 20%, depending on what the tax authority feels like doing. Any question? So you could say turnover assessment will occur where the tax authority, where the taxpayer informs the tax authority that there is no accessible profit, or there is accessible profit, but the accessible profit is less than expected. Okay, therefore the tax authority has rights to assess the taxpayer to tax on a fair proportion of its turnover. So that is that. The next one that we're going to talk about is minimum tax. Let's talk about minimum tax before we come back to talk about the total profit.
I have a question.
We start on minimum tax today. Now,
I have a question, sir, please.
right.
So, what about a situation where the tax payable, maybe the tax is charged on the turnover, but was supposed to be deducted from the profit? So, what if the tax is bigger than the profit, the actual profit for the year?
Yeah, but they have told us they don't have profits. So we'll just go ahead and take it on their turnover.
Sir?
So the taxpayer already informed the tax authorities that there is no profits.
No,
Or-
sir, not in that case, sir. Like the company income tax is charged on the turnover, right? And deducted from the profit.
it's charged on total profits.
Okay, total profit. Okay, sir.
Profit is not tax is not charged on revenue. But the only situation where tax will be charged on revenue if the tax authority began to notice that the taxpayer is trying to evade tax. They will now say, okay, you have told us there is no assessable profit, or you make loss. No problem, you have made loss, no problem. Or you told us that the profit that you made is like 10 million, while other people in the industry that have the same capacity that you have are declaring like 100 million as profit. You are telling us you made 10 million. You have the same capacity, you have the same level of production. You are producing 10 million. That one is also producing 10 million. The other guy told us that he made 100 million as profit. You are telling us you made 10 million. It's not possible because you have the same capacity, the same production capacity. So if you're not telling me you make, let's assume you say you make 80 million, I can say, okay, yeah, it's still reasonable. If you say you make 70 million, it's still reasonable. But you're telling me that you make 10 million as profits, it's not reasonable again. I will now result back into your turnover and charge you on your turnover on reasonable proportion. That's what we are saying. Do you understand? So let's go. The next one is minimum tax. Minimum tax will become applicable where, number one, there is no total profit. That's number one. Number two, tax computed is less than the minimum tax. Where the tax computed is less than minimum tax, then we will say the taxpayer. We will say the taxpayer will be charged with tax on minimum tax. Do you understand? So number one, we have said there is no total profit. Number two, there is total profit. So there is no total profit. Number two, you have said the tax computed is less than minimum tax. Minimum tax is minimum, as in you're not computing tax. Let's assume you computed a tax, you have 10,000 and minimum tax gave us 100,000. We take minimum tax. And number three is companies with accessible loss or taxable loss in the year. So you have made loss. So we compute minimum tax. So how do you compute minimum tax? Minimum tax is computed at the rate of 5%, 0.5% of the turnover. Minimum tax is computed at 0.5% of the what? Of the turnover. So that is where we end the class today. If you have any question, you can ask.
Hello, sir.
Right.
Okay, my question is from the inception of Finance Act 2019, we've been told that CIT is on turnover,
No,
right?
no. The determination of the rate to use,
Okay.
you will check it on turnover, but your computation of tax liability is still on your profits.
Okay. All right, sir. Thank you.
Any other question? Any other question?
Sir, in a situation where a company makes loss, right, and minimum tax is charged, are you saying the minimum tax will be deducted from the turnover? That is increasing
No.
the loss for the year.
No.
Okay.
The minimum tax will be paid. That's what is going to be paid.
So how will it be paid since the company is already making loss?
So minimum tax is computed on the turnover. You go and check the turnover. They made turnover that year now. Do you understand?
No, sir.
The company has turnover. They are making sales. It's just that their expenses is more than their sales. Abi? And that is what resulted into loss. So because they are making sales, you go and compute minimum tax based on their sales. That's what we are saying.
So my question is, how did they pay? Is it like they will carry it over to the next year since they did not
No,
have
they will
any
pay that
money?
year. What is carried over? They will pay. Any other question? Okay. In the absence of none, we call it a lecture. See you again by the grace of God next week, Saturday.
Thank you, sir.
Restful week.
Thank you, sir. Sir, please don't forget the material.
I will send
the
it.
materials.
Thank you,
I'll send it before the end of the week.
for doing my turn.
All right, sir.